Good afternoon, everybody, and welcome. Thank you for joining us today. My name's Tim Graham of hotspotting.com.au, and I'm delighted to be your host for today's webinar entitled Tax Effective Investment Strategies. A little housekeeping before we get started. Today's webinar will run for roughly 45 minutes. We hope to have about 15 minutes worth of Q&A at the end. You're welcome to ask questions throughout. Just please use the Q&A box, or if you are joining us on Facebook, you're welcome to ask questions in the comments there. We'll endeavour to get back to as many questions as we can, but if of course there are some left over, we will come back to you after the webinar concludes. But to kick things off, I'd like to introduce my award-winning panel today. I've got Shukri Barbara and Amir Ishak from Property Tax Specialists in Sydney. Gentlemen, thank you so much for joining me.
You're welcome. I'm Shukri.
I'm Amir.
And together we're the Property Tax Specialists.
God, you guys have done this before. I actually look for a lot of people, they probably don't realize that when we host people on our webinars, it is by invitation only. So, we don't just put anybody on here. We've selected Amir and Shukri for a reason. If the only action point you take away from today's webinar is to go and follow them on, their newsletters and things, they put out great content, and we've chosen you for a reason. I really appreciate, especially this time of the year, to be taking time out of your busy schedule to come and join us and talk about everything tax.
Thank you for the opportunity, Tim. Really appreciate that.
Thank you.
All right. Now, I introduced you as award-winning accountants. Let's start there. I believe tomorrow you're off to the Australian Accounting Awards again. 2021, I believe, Amir, you won the award for Property Tax Specialist of the Year.
Property Specialist of the Year, Accountant of the Year, yes.
Very good. And then Shukri, you took it off in the following year. So some fierce rivalry heading into tomorrow.
It keeps us on our toes.
That's it. Well, listen, I really appreciate you joining us. Let's get started. Why don't we start with you, Shukri? Tell us a little bit about Property Tax Specialists and how you started.
Mate, I've been in accounting since 1985, and it was just a couple of months before Paul Keating came out with dividend imputation and capital gains tax.
Oh, yeah.
And that was a challenge until the year 2000. Olympic time stage, and I went to some seminars, and some of the people promoting property were standing up there and said, well, listen, I can tell you about how to make money out of property, but I'm not an expert in the tax and so forth. And I said, yeah, but I am. And I started to climb off that and right off the back of that. And we just focused on property tax specialists because that's what we do. We're supporting people because he was telling people how to make money out of nowhere. Yeah. And we say, yeah, but you need some skills in the compliance side, in the advice side, in order to maintain all the profits you're going to make out of the property. Yeah. And so here we are today. And Amir came and joined me 3, 4, 5 years ago. And we're going forward together.
Very good. And Amir, you've got over 20 years in public practice and chartered accounting as well. So was that 50 years between you?
Bit more, I think. The grey hairs on us, I think.
that's why there's no hairs at all.
You had hair up until a couple of years ago when he joined you, right? Very good.
Yeah, so my background is quite different. I started in public practice, went to business for big developers, then went to financial institutions, so got the finance kind of part of it, then back to big developers. Then I joined Shukri when I moved to Australia, then went Big Four and saw the light again and came back and joined Shukri in this practice.
Yeah, very good. Well, look, I mean, as we know, in a lot of industries, you've got people that specialize in different areas of competence. And I suppose in accounting, not all accountants are made equal. A lot of accountants just specialize in income tax. But, for a lot of our viewers today, they are either property investors or are certainly interested in property investment. And that can be a daunting experience at the best of times, just thinking about where to buy and what to buy. But some of the things we'll talk about today are what entity you buy in, and I suppose some of the pros and cons to buying within trusts and outside of it. So I understand.
Tim, a lot of the focus we try and do when we're talking to people is saying, well, look, we specialize in people who invest in property. So the key really is people and how we go forward in supporting them and what they want to achieve. And tax is part of that, major part. That's where we're at because we're accountants as well who specialize in that space.
Oh, very good. All right. Well, eager to learn. So let's get started.
All right.
So
Okay, so here we go. So we're starting out with that's the program today.
And
that's us. We've already been through that.
Today's objective is mostly to create awareness. So it's all about you being able to ask the right question, but more importantly, how to make informed decisions.
So what we're going to do is we're going to ask the basics question about tax planning and structures. We're going to ask, well, why should you structure? What structures are there to be used? What are the costs and implications of changing structures? What are considerations for structuring? Usually best before purchase.
And the key is before.
Yeah.
So just formalities, whatever we talk about today, of course, is going to be of a general nature and educational only. So you should not go and act upon it without advice specific to your personal situation. So that's the basic disclaimers we've got, okay? You need advice, you need it to be specific to your situation. Take this as such.
So I'm a limited authorized representative of Merit Wealth. What that means is I can advise on super funds formation and buying property within super funds.
So let's start out with some of the questions that we do get. Okay, an example will be a property that's in John's name. He bought it with a negative, this is a residential property, bought in with an intention of negatively gearing, taking the rental loss offset against his other income. So he gets a bit of a refund. Has owned it for a few years. Now it's turning positive. And the question we get from John is, can I transfer the property or allocate the positive income to my partner? Well, that's a pretty often asked question.
Another question we get asked is, the property's in a trust. Tom pays land tax and the property is negatively geared. Can Tom transfer the property to his individual name, maybe benefiting from the land tax threshold or the negative gearing?
Another question we get asked is, look, Jason's here on 180 plus in terms of income, and he's got a positively geared commercial property. Can he transfer it into his self-managed super fund? And further on, we get things like this. A lot of people want to do some developments. They go and buy land. A lot of the considerations around constructing two dwellings, let's say. Around Sydney, there's a shortage of land. So the larger blocks in the well-heeled sort of areas, they want to subdivide. So people are asking questions. Can I keep one, sell one? What is the best position? Should I sell both? Can I keep both or one for rental? Occupy one, sell one. Well, what are the options available? Key is what we do is we try and help out and answer those questions and put alternatives so that people can work through that opportunity.
And that's the key, because sometimes people approach us with a certain thing in mind. They want to achieve a certain objective and they've spoken to someone and they think it's 1, 2, 3. But there are very different ways of approaching a situation. So there is no one size fits all. It depends on the person's circumstances.
And obviously circumstances can change as well. So I think
Absolutely.
having a discussion around your intentions from the start's one thing, but you really need to plan out what the future looks like as well to ensure you have got the correct structure in place.
Pretty much. So we start out with saying, the management guru, Stephen Covey's comments, how about we start with the end in mind first?
Yeah.
Do you want to protect your assets? Is that your priority? Or do you just want to minimize your tax? And is there a trade-off between the two? You want to maintain, maximum profit, or do you want to keep a legacy for the family? So these are some of the things that are there. And with that, well, who do we help?
So we help people structure investments to minimize their tax legally, of course, maximize their returns, protect their assets while keeping the ATO happy.
So here's an example. Okay, something is going on there, but there's a second phone calling. But look, one of the examples they're going around with as tax rates, and Amir will just don't worry about it. Just go on here.
All right. So sorry for that. So as an example of 22 tax rates, part of the tax minimization is these are the tax rates for 2023. if someone's on $250,000, they will be taxed on the $250,000 and will pay about $88,000 or an average tax rate of 35% tax rate. If there is a way to legally split that income between two people, then each will be making 125, reducing their taxable income to only 33,000 each, which is a saving of about over $20,000 a year.
Between them, yeah.
Which is, think what you can do with that. So when to start? Before you sign on the dotted line, and that's critical, because once you've signed, it's usually too late. And we get asked this question a lot. One of the most frequent questions we get asked on these webinars is, I've got this, I've done this, can I change it? The answer in most cases is yes, you can, but it will cost you. And in most cases, once we do the analysis, people realize that it might not be best to move things around, but for the next one, plan it correctly. In rare cases, there could be a situation where you can move it and it will be beneficial for the client. So this is, before you sign on the dotted line, and this is for every purchase.
So the question is going to be, where do we start? So when we meet with people, we like to review what their personal life circumstances are. So people should consider where they are in life. Then they should also consider where their tax circumstances and opportunities are at that point and going forward. Then we look at the structures. Are they appropriate for the ownership of your share of the property if there's more than one person? Test it and see if it's suitable. Then you've got to make sure that the finance is available, because really without the money, a lot of the property purchases are not going anywhere, and particularly in the current environment.
And back to your point, Tim, it's always, the circumstances change. So it's best to understand why you're doing it, because you're making a decision today that you don't know what the future is, but making the best, most informed decision now is key, because a few years down the road, if you don't know why you made that decision, and that's what we get. A lot of clients come to us, I've got this, I don't know why, they told me to do it, and they don't know why. And
I think what you just said there, they don't know why. It's because they've been given a recommendation maybe from a real estate agent or their broker to do an ownership split that sounds right for now. And I've seen this many a time where someone goes and does a 99 and 1 split, and then that person who's got 99% ownership for one reason or another is no longer working. So for that tax year, there's no tax deductions on the 1% of the person who is working. So it really does take, pay to get advice from, qualified people, because otherwise it can cost you a lot more money in the long run.
Yeah, one of the other culprits is barbecues as well. That's one of the key things.
Barbecue advice, yes.
Yep.
And that's and that's important for the example you've just given, 99 to 1. There may be some good rationale about it, and you've got to work with a bit of timing, short term, long term, that sort of consideration over the period. So people keep coming asking us, well, look, well, you're the accountants. What do you reckon? So look, when we're doing some planning, the big picture of what we look at is there a way to split that income based on that example that Amir showed earlier on, right? And then you've got timing. Can we increase the yield by moving things forward or delaying? For example, we're about 2 days away from financial year end. On capital gains, it's the date of the contract that makes a difference. So if somebody signs for a sale with a property that's got a capital gain, and then they settle 6 weeks from now, they have to report that capital gain in the 23 financial year. But if they signed on Monday and the capital gain comes in, they don't have to report that for another 18 months when the next tax return comes in. So you can keep the tax money, and a lot of our clients will use it to finish other projects. So that's some of the benefits of those sorts of things. And also, you've got to remember, capital losses can only be offset against capital gains. Yeah. So if you've got a year where you're going to have to sell something with a capital gain and you're holding on to something like Telstra shares that are bought at $7 and they're worth about $4 now, then you might want to offset one against the other one. So you sell them at the same financial year to offset the loss against the gain before you go to the tax return. And then you've got to go to structuring, have a look. How's it going to work? So Amir, why should we structure?
So we structure for a lot of reasons. One of the key things is to protect your assets. The assets that you've worked hard for, how do you protect them from frivolous claims? Another thing is to minimize your tax legally. How can we tax plan legally and potentially split income? Hide the wealth from the public eye for privacy reasons. Planning for retirement. So you've worked hard all your life. How do you reach a stage where you retire comfortably and in a tax-effective manner while your assets are protected? And finally, how do you pass the assets that you've created during your lifetime to the next generation without triggering stamp duty or land or capital gains tax?
So all we've got to do is we've got to ask a few more questions into considerations, and that's look at the risk profile for the particular person. Are you a brain surgeon? Are you in the property industry? Are you in the hospitality industry right now? So these are major issues that need addressing just to make sure your family doesn't live on the street. Then you've got to look at the income tax. How can we minimize it overall? Then you've got to look at trade-offs between one and the other one. I think we mentioned that earlier on, and that's important. What's your priority overall? Retirement age, how old are you? How long have you got to retirement? How much income you're likely to make? What sort of industry are you in? Then we've got the family succession and the children. How old are they? Can you rely on them? Have they got partners? Are their relationships stable? Are your relationships stable? And then we go look at, a little bit into the crystal ball and just see what's the future outlook going to look like? Where's your cash flow going to come from to support some investments, particularly if they're going to be negatively geared? And finally, you've got to work in a position on structuring that allows the lender to give you the money to move you forward.
And this is a key issue these days as well.
Other considerations you got to take into account is that, where you've got split families, who's actually the controller, who's going to benefit, is things going to be challenged somewhere along the line, and going forward. Then what sort of property are you buying? Residential, commercial, land, or development? Each one of those things have different positions, whether you're going to be in the development phase, you're going to sell it, you're going to hold it for rental. But most importantly is that item 4 we've got on the screen there. And what happens is that when you're trying to develop and go, you've got to remember that GST is only payable in terms of residential property when it's brand new. Mm-hmm. So the tax office comes out to your intention, right? It's not defined in the Act anywhere, but they ask the question, what is your intention? They've got hindsight because they're coming in 2 years and afterwards to ask those questions. So you've got to be clear about where you're going to go. Are you a developer? Are you wanting to just make a one-off profit? Or are you developing and keeping, therefore moving it away from being GST and being into an asset for rental income? And therefore, you'll be eligible for 50% of the capital gains when you come to sell in a few years' time.
Again, depending on the structure you've got it in. So there are so many multiple layers you've got to look at when considering these things.
Yeah.
Another consideration is that timing I mentioned before. Are you in it for the short term or the long term? What tax benefits we're looking for? How can we use up losses? Splitting of the income, and finally that financing, just coming back to that financing, because that's where your starting point is.
Yeah, and back to your point about the 99%, 1%, that's exactly it. Do you look at, from the tax benefit, do you look at for the short term, long term? Do you reduce tax now and pay tax later, or the other way around? Mm-hmm. So it's all these things are consideration. You've got to do it at the start.
And then, of course,
I've noticed a big uptick in people that are holding ABNs now as well, whether they might still be PAYG, full-time employee, but a lot of people have an ABN now for the purpose of reducing their tax and dispersing income. So no doubt that comes into the planning here as well.
Well, we have to look at the details for that and see how they're structured apart from just an ABN. An ABN just means you're carrying on a business.
Yeah.
So where's the risk with that? What sort of business are you in, and so forth. On the 99 to 1 position, as I'm being reminded always, happy wife, happy life. And so a lot of the times the 1% is to keep the wife happy and finger on the pulse. All right. So there's emotional issues as much as there are just numbers. It's not all about the numbers. It's also about the people.
Yeah, we get a lot of people who want to plan their lives around to minimize their tax. Does not work like that. You've got to plan your life. Tax fits in afterwards.
Yeah.
And back to the ABN issue, you've got to look at the income, and are they personal services income? Does it have to be taxed in them? So there's a lot of consideration around that, and that's an area of focus for the ATO as well. So you're right, it can work, but you've got to do it correctly.
Yeah, that's right.
So what are the investment structures that we've got, Amir?
So you've got the individuals.
They can sue and be sued in their own name. Simple to set up because you just sign, you've got your name, you're qualified, you can do everything in it. Difficult though on the side that you can't split the income, so can't really reduce the tax. And where you go into a partnership and then do split the income, the risk of the partner also exposes the other partner. So you've got a few bits and pieces there. With the individuals and the partnerships, you can take advantage of the 50% discount on capital gain when you're owning the property. The losses can flow straight through and offset against other income as well. Then you've got the companies. Companies are great because your liability is limited to the number of shares on issue, as long as you don't give personal guarantees as a director. And the tax rate, if you're carrying on a business of development in the company, that's terrific. The tax rate's only 25%. The problem with that is when you come to pay it out, then you pay it out as a dividend with the franking credit of 25%. But when it hits your individual name, you may reach up to the 47%, and the difference is paid in the individual return. So it does have advantages, but it has disadvantages as well, that you can't do these things.
Then we've got trusts and super funds, and we'll go in a lot more detail later on those, because that's, I think, an area where a lot of people need some more clarity and understanding of it. And that's where we get to ask the most questions around.
So look, for trust, I thought a bit of history would be useful because really a lot of people don't understand what a trust is. An individual is, of course, an entity in common law. A company is an entity in corporations law. But what is a trust? So if you've ever seen that film with Russell Crowe, Robin Hood, that's an excellent film to put the position of where it's at. At that time in medieval England, King Richard wanted to go crusading into the Middle East. So how long was he going to be? He's going to be away for a lot. So who was going to look after England? So he goes over to his brother, Prince John, and he says, look, I appoint you trustee. That makes him the legal owner. He says, I entrust in your care the assets and estates of England. So he gives him some assets to look after. And then he says, your job as trustee is to manage it on behalf of the people. And the people are the beneficiaries. And that concept still exists today, and that's how it all works. Now, in that story, of course, Prince John does the wrong thing, and that's where Robin Hood turns up. But in current days, now what we want is for the trustee not really to be an individual, because if they die or if they become incapacitated, then all the documentation has to be changed. But where it's a trustee, where the trustee is a company, then the name on the title doesn't change. So when you transfer the control of the trust, there is no capital gains tax, there is no stamp duty, but we legally take it across to the next generation. It maintains continuity quite nicely. And of course, it also provides asset protection, right? Where is the asset protection? Well, for a family trust, Amir will talk about those in a minute. So it provides it there, and I'll add to that in a moment.
So what kinds of trusts are there? The most common one is called the discretionary trust or a family trust. That's the most referred to. There's another type which is called a fixed trust or a fixed unit trust, which is very good for an unrelated group of people if they're coming together, pool funds. Each one knows their percentage in the capital and income. And it's a very good function for that. There's the testamentary trust, which is activated as part of the will. It's so when someone passes, that's when it becomes effective. And a testamentary trust has some very good benefits for minors, where if the assets are left to a minor, they might be able to be taxed only on the adult rates for that income that's generated from that trust. Then there are two very They were popular a while ago, but the tax benefits have gone from them, so they're very less.
Yeah, they're specific to certain situations. They're still useful, but you really have to have specific situations going on there. So for discretionary trusts, a lot of the family trusts, the question is, what are the advantages? Well, you can protect your assets, you minimize your tax, like we said before, by planning and flexibility, because you must distribute any profit at the end of the year. So by the end of the year, like now, and we're approaching people right now, giving them all the minutes to make those decisions. So we look at what they've earned up to now. We find out which member of the family has got the lowest marginal tax rate, and the decisions made to, say, distribute the income of the trust to that person. So as a group, the amount of tax is lower.
And you can stream as well. So if the trust has a capital gain and an individual in the family has a capital loss, you can stream that to, if you do the resolutions correctly, you can stream it to that so that one person benefits, the other person benefits from another thing.
Yeah. Frank dividends is the alternative. You find somebody who doesn't have any other income, and the franking credits will come back as refunds. You can also hide the assets from the public eye. That's another benefit we spoke about before. We've got succession planning, which leaving the legacy to the children. We've got retirement planning. Again, that takes a bit of work, a lot of the times with the financial planner. And finally,
you've got the family trust selection, which is very important if you've got several trusts or got losses, and if you want to distribute frank dividends above a certain level, the family trust selection is a key thing to consider.
So what are some of the disadvantages, Amir?
So land tax is a key consideration to look at. In New South Wales and Victoria, there's very limited threshold for trusts. As opposed to an individual who has a threshold that they can benefit from the land tax.
In New South Wales, 969 of land value.
And as land values increases, that increases. So that's something to consider. In Queensland, there is still a threshold for trusts up to $350,000.
That's it.
So that's one consideration. But if you've already got properties in your name and you're paying land tax, then it's actually doesn't matter. Or in other cases where we've got clients that the land value is very small, but the property is generating commercial property that's generating a large yield. And then that gives you, so the benefits from tax planning outweigh the land
So
tax.
what happens in that situation is we allocate the net income that has to come out from the trust to the spouse who's got no income at all. So notwithstanding there's a very small land tax, the actual saving from the income tax makes up for it and more.
So instead of paying 50% on $20,000, that's $10,000, they save $10,000. So overall, it's a benefit. Then the other thing that people kind of look at the start is the costs of setting up. That is a one-off cost. If they take the long-term view, it's a cost of doing business. The complexities at the beginning, we're here to explain it. That's why we have these webinars, to explain it to people. And another consideration is dealing with finances, especially a few years ago. Now, we find a lot of financiers prefer trusts to be set up. They understand them, they know them, they deal with them well. And as long as it's done correctly, it could make the process a lot smoother. So that's something you need to speak to your broker about. Where you're going to get the structure. And the last thing is foreign persons. There are some surcharges on land tax and stamp duty for residential property if there's a deemed foreign person. So that's something to consider when setting up a trust. A lot of people miss as well.
What about property in super, Amir?
Property in super is very good in certain circumstances. Again, this is not advice to speak about super. You've got to give a statement it's a long process. But as general advantages are, you pay tax at 15% only. So if you're on a very high marginal tax rate, you could be saving a lot by putting some additional money into super. Another thing is if the asset is sold, the capital gains tax, effective capital gains tax rate is only 10%. So that's another thing as well. It protects your assets from creditors. It's very good for people who are 50 and above. Below that, you've got to look at it because you're putting money away for a very long time. So you need to look at it. And if you sell the assets, and again, if there are no law changes with the current or future governments. If you sell the assets while you're in pension phase up to a certain limit, it's totally tax-free. So if you buy a property, then after a few years, you reach the condition of release, you retire, then you sell that property, it's tax-free.
But what
also,
is
also a big benefit to being able to leverage with non-recourse loans within the fund as well.
That's also a very good benefit, but again, you've got to make sure it's suitable for you.
Yeah.
Okay. Some of the disadvantages is you can't get the money out of the super fund. The contributions are limited. There are lots of limits. You can only contribute up to $27,500 per year. There are some bring forward rules and things like that, but that's the limit. So if you're already on a high marginal, high income, it might not be, you might not get that benefit. The other thing is liquidity. If you have a bulky asset like a property in a super fund and one person is retiring from the super fund and multi-member super fund, planning ahead for that is key, because you don't want to sell the property if it's a really good property just to pay out someone. And the detailed admin for super funds. So the ATO gives a lot of tax concessions for super funds, so they want to have a lot of admin to make sure that everything's being done correctly. So that's an area.
Because the objective is to have income for retirement, and they don't want people coming back and asking for pensions on the public purse, as opposed to making sure you keep it and then have it privately held for that. So at the end of the day, in Shakespearean terms, the question really is to trust or not. So the consideration is going to be, your risk profile is the starting point, and considering what is yours, if you've got a high risk profile, then yes, I certainly will look at structuring. And trust may be a major part of that. If your risk profile is low, then maybe, because then we got considerations of land tax, etc. Then you got to look at other things like cash flow and gearing. Is the property going to be positive or negative? That will determine whether you want to go into it or not, and for how long. So timing is always going to be there.
Because one of the disadvantages of trust also is that the losses are quarantined in the trust to be offset against future income. So that's a very important consideration for you before you go in, so that you don't end up with a loss and high income outside. So again, you've got to look at your whole circumstances, the whole picture, your time frame, and all the aspects of that.
So the question is going to be, to trust or not, get some professional advice and plan with each new property. Really, that's the point. Before you sign, as Amir said at the beginning, right before you sign, because it's hard to change at the end of the day, and it's expensive. But planning at the beginning helps to minimize any of the problems.
So the people we help are the aspiring investors who looking to buy their first property, already have the first property. It usually is positively cash flowed, but negatively geared, and they're usually on PAYG income. Then you've got the experienced investor who has 2 to 5 properties. They'll be either on PAYG income or business income. They've already started to consider trusts for asset protection and tax planning. So they would have considered trusts in companies, and they would have probably set up a super fund as well to benefit from the tax benefits in that, and would have considered their estate planning as well. And finally, the veteran investors who have 6+ properties with business income, usually they would have considered the structures, companies, and trusts. They would already have that, and SMSFs and estate planning, maybe doing subdivisions and joint ventures.
So really what you've got to do is you've got to calculate the economics and cash flow of the proposed transaction. That's your first step. Then discuss the strategy, the proposed strategy for making the money, and plan the ownership structure and exit first. See how you want to exit out of it with a minimum tax and maximum gains, and how you're going to transfer, and then get the professional advice. So why
do you need the professional advice? Think of how much it will cost you if you get it wrong. Compare that to the value of good advice.
So what do?
We provide advice around structures information, compliance, so tax returns, GST, capital gains tax calculations, and SMSF compliance, analysis for projects and companies, tax research for special projects. We've got a few really interesting people who are doing interesting things, and we help them out with the tax research, tax consequences, and planning that out. We also can provide you a statement of advice if you're looking to for SMSF formation and the compliance for that.
Thank you, Tim, and the audience. If you've got any Q&A for the next, we're happy to go with that.
Thank you very much. That was great. I think everyone would have got quite a bit of takeaways from that. One of the first things I was going to say is that you mentioned exit strategies a lot there, and I find that so many people are so eager to get into any type of investment that they're thinking about the now and not so much the later. And I think, as you say, planning for that exit strategy early is so important. It's a very, very expensive exercise if you do happen to get it wrong. So look, we do have a couple of questions. Anybody else that would like to jump in for some questions for Shukri and Amir, feel free to jump in. The first one I had, though, to either of you, everyone wants to choose to answer this one, is difference between tenants in common and joint tenants.
Look, a joint tenancy is like mum and dad. What happens if one of them passes or anything happens? The asset automatically flows over to the other person without having to go to probate. Mm-hmm. But tenants in common means your interest in the property goes to your estate, and then through the will, the estate determines what happens to that. That's the basic differences.
Okay, and then short of somebody passing away or anything dire like that, what about annually? Is there much benefit to either of those, or are they much the same?
It's the same impact. There is no change. The key is that if one of them gets in trouble, let's say they get sued or anything, it has an impact on the other person. So if that property becomes the subject of a claim by a creditor, then the other person may also lose out.
Okay. And just a question in relation to inheritance. Is there inheritance taxes, or can you avoid those taxes through the correct structures?
Yeah, well, look, in inheritance, the basic rules are like this. If it's your main residence at the date of decease, the question is going to be what taxes are there, right? So usually on transfer, you're looking at the capital gains tax position. And the capital gain is calculated as a difference between your selling price and what is called your cost base, right? Now, if it's your main residence, the cost base becomes the market value at the date of decease, okay? And you've got 2 years in which the estate can sell it with no tax impacts at all right? Then, if the deceased also has investment property, then the cost base becomes the cost base of the deceased becomes the cost base of the beneficiary of the estate. And so there will be a capital gains tax to sell, but capital gains tax is only on the sale. So they can get it in the estate. Nothing will happen until there is a sale.
So that's the key.
That makes sense.
Yep.
I've got another question here. If you purchased a property as an investment, rented it out for a few years, and then lived in it for 1 year as primary place of residence, do you get a reduction in capital gains tax?
All right. So the rules around main residence exemption is one of the best tax concessions that are available. And there are lots of rules around it again. If you establish a property, as you buy a property, you establish it as your main residence, you follow all the criteria, that becomes tax-free as long as you have no other nominated property as your main residence. So you can only have one main residence at a time. If, on the other hand, the property starts its life as an investment property and you live in it after a few years, there'll always be a taxable component and a non-taxable component if you claim that property as your main residence. So there will be a pro rata calculation. Yes, it will reduce it. It does not eliminate it, but it will be reduced.
So, for example, if the person has rented the property out for 5 years and lived in it for 1 year, when it comes to be sold, the difference between the selling price and the purchase price. In this case, the purchase price is going to be your cost, plus your stamp duty, plus your legals, plus your holding cost. Yeah, and then once the capital gain is calculated, it's apportioned. 5 years component out of 6 will be taxable. 1 year, because you lived in it, will be exempt. So you can't really just turn it from being non-taxable into non-taxable at all.
Yeah, no, that's good advice. The other one is in relation to first home buyers grant. Now, I think it's probably worth mentioning that every state has a different ruling on the first home buyers grants and stamp duty rebates. But the question is, this person's been rent vesting for the last 10 years and has a number of investment properties, has never had an owner occupier, but are they still entitled to the first home buyers grant? As I said, it's probably a state level question, but
yeah, it is.
Yeah.
It is.
So there are 2 levels of taxes. There's the federal tax, which is the income tax kind of, and then there's the state level tax. We cannot comment on state level tax, but what we'd look at is based on the rules in that state. Again, each state is different.
Look, that information is available on the Revenue New South Wales website. Mm-hmm. You can easily get into it, but broadly speaking, from historical positions, they want to give the benefit to people who haven't owned anything. But since the last government, just before Perrottet government exited, they tried to relax some of those to get more people into homes. And now Minns is also planning to do some of that. There's just limitation on the value of the property that you're going to buy. But all of those details are on the Revenue New South Wales website.
Very good. Well, that's all the questions we have right now. So I think unless anybody else wants to jump in the next couple of minutes, we might wrap things up. But Shukri, Amir, thank you so much for taking the time out to join us today. I think everyone would have got a lot of great value out of the content you produced today. I would urge everybody, look, as I mentioned at the very beginning, even if you're not ready to book an appointment or, take on the boys for your tax advice straight away, by all means, make sure you flick them a message and at least get put on their newsletter list, because the content they put out is very, very handy. So thank you both for joining us. We want to wish you all the very best again for your award ceremony tomorrow. And hopefully we can see you again soon.
Tim, what we'd like to say is that we wish you and your team and all your viewers and members a very happy, healthy, and prosperous new financial year.
Very good. All right, boys. Thank you so much. We'll chat again soon.
Thank you.
Bye-bye.
Thanks, everyone.